on Apple TV that I watch,
Right.
which is, but does there need to be a wow moment in terms of new, and there probably will be. I mean, if anyone's going to do it, you figure Apple could still innovate into a whole new area, but they don't necessarily need to justify $3 trillion.
I agree with that completely. I think the biggest worry is China. They get 14% of their revenues from China. You never know what's going to happen with the current regime. And so I think they've been, they've navigated it, and demand is growing. They gained 300 basis points in market share in China over the last year. So I think that's just the thing that we're watching. And one of the reasons why we've taken some of our gains. But, in the last year since we sold it, the stock's still up, or trimmed it, I guess you would say. The stock's still up 35% versus 25 for the S&P. So they've continued to deliver quietly. And last thing I'll say, Joe, is that you keep hearing people say that rising interest rates and rising inflation is bad for technology companies. You know how long I've been doing this, and that's just simply not the case. And the digital transformation is well in the early stages still. It's not over. So I think you want to have Apple in your portfolio, and it's not going to outperform every month or every minute, but it is going to give you decent returns.
I'm told we got to wrap it. Just one more thing. So Apple, you're spending a lot on innovation. You've got a great workforce, but you don't necessarily need to add anyone. You look around, you may not want to do an acquisition. Is there any better investment than your own stock? So they've been big buyback. Would the stock be where it is right now if they had not done the buyback? Was that a positive corporate strategy that wasn't evil and self-serving?
Yeah, I think it is. It has been a great investment. I mean, they have raised the dividend about 10%, 9% annually for the last 5 years. But yeah, and they've put a floor under the stock. Just to
but we hear that knee jerk. Oh, they're goosing the stock. Blah blah.
Yeah, no.
Obviously, it can be an effective corporate strategy for a company like Apple,
Absolutely.
and they should obviously be in a position to decide: do I issue stock or buy back stock?
And by the way, any executive who sold shares.
Yeah, sold way too soon.
Right.
But they got 3/8 of a point advantage on the day that they did it during the buyback.
But it's not like they're making money off this or manipulating somebody.
3/8 of a point. 5/8 of a point. All right, Nancy Taylor, good to see you again.
You
remember me? We look
yes, I do.
We look exactly the same. We look younger. I think both of us.
That is kind, but I think you just lost a lot of credibility.
Saying both of us. See you. Especially you. Thanks.
It is just after 7 o'clock on the East Coast, and you are watching Squawk Box right here on CNBC. I'm Becky Quick along with Joe Kernan. Andrew is off today. Been watching the futures, and so far this morning, not a huge amount of movement. The S&P futures are up by 2 points. NASDAQ up by about 41. The Dow's down by about 22 points. Dow component Walgreens just reporting, so let's get over to Bertha Coombs. She's got the numbers on that. Hi, Bertha.
Hi, Becky. Walgreens beating on both the top and the bottom line with adjusted earnings of $1.59 per share compared to a $1.40 consensus estimate on revenues of $33.8 billion versus expectations of $33.4 billion. COVID again helping drive pharmacy, which saw comparable sales up 7.3%. Walgreens administered nearly 12 million vaccines in the quarter and more than 6.5 million tests. Prescriptions were up 4.7% year over year. On a net basis, operating income actually fell from a year ago due to increased investments in things like micro-fulfillment centers to automate prescriptions on the back end and expansion of Village MD clinics in Walgreens stores, which is a cornerstone of the new Walgreens Health division. On the retail side, U.S. sales rose 14.7%. UK sales were up 22%, though in the release, Ross Brewers says they are continuing the, quote, strategic review of Boots, i.e. they're still looking to sell, looks like. On both sides of the pond, Brewer told me supply chain is improving, but inflation remains a big challenge.
Supply chain is improving. I'm seeing an improvement as we were just placing some of our seasonal merchandise that comes from overseas for both Valentine's and Easter. So we're seeing some improvement there. But what I would love to see a little bit more work on is, what we're doing with inflation. We're unfortunately having to pass some of that on to the customer, but we're also looking at ways to reduce our cost and pass that on to really offset what we're seeing in inflation.
Even with those headwinds, operating margin topped estimates at 5.2%. Becky, you can see shares there are moving higher here in extended hours.
Watching some of these things, as brewers putting greater emphasis on Walgreens Health, just as the company is kind of turning through some of these things, are they considering the idea of stopping selling tobacco? We just heard that from Walmart. CVS did that when they started focusing on health, too.
Exactly. CVS did it back in 2014. And that's exactly what I asked, as they are really focusing on health. I asked Brewer that during our Healthy Returns conference. Here's what she said.
Can Walgreens Health continue to sell cigarettes? That is one of those things that I am personally looking at. I think it is something that you'll hear us talk about and make some announcements about in short order.
It is one of those things that some shareholders have been asking.
Absolutely.
For a while.
I hear them.
Perfect.
Loud and clear.
The interesting thing in New York City, since 2019, they haven't been allowed to sell cigarettes in their stores, and they report numbers ex tobacco, and those are usually about a point higher than the overall sales. So it sounds to me, Becky, like they're leaning on stopping.
It does. It sounds like she gave you a pretty clear signal of which direction they're headed, which brings you to the next question for the tobacco makers. If it can't be sold in a Walgreens, in a CVS, or in a Walmart, you are running out of some pretty important sales points for reaching your customers, too.
Yeah.
Leave that shelf space open for the wacky tobacco.
They're shrinking the shelf space because they're leaving more space for Village MD for the primary care.
Funny cigarettes,
the store is
Bertha.
shrinking.
Maybe funny cigarettes are coming.
It is. It is interesting watching these different trends.
Leave that shelf space open. We could put it right here. I mean, it's in front of the federal government again. I
know.
Yep.
They're considering it right now.
Yep. You never
Hey,
know.
Bertha, thank you. I think that was a pretty heavy hint of which direction they're leaning on that. Good to see you. Thank you.
Speaking of wacky tobacco, Steve Leisman said the markets are waiting. Just kidding, Steve. Just kidding. Just kidding. The markets are waiting to see if the Fed can orchestrate. He's a huge Grateful Dead fan. Huge Grateful Dead fan.
Doesn't make him a huge
No, it doesn't. Not currently. Anyway, orchestrating a soft landing for the economy, but recent Fed speak is not showing any signs of real confidence. Steve Leisman joins us now. Big day.
Joe's projecting against.
Maybe I'm projecting again. You know what I said? I've said that. I never exhaled, I think, is the problem. Anyway, go ahead, Steve.
Thank you, Joe. While Fed officials are not predicting recession, their comments show they're not ruling it out either. Faced with the uncertainty of the impact of Russia's war, which threatens to drive high prices even higher, and the unknown, of course, of how much restraint will be required to control inflation, Fed officials are speaking with far less confidence than normal about the economic outlook. Fed Chair Jay Powell is recounting of previous successful efforts by the Fed to rein in inflation. He says it's been done 3 times before. At his NABE speech, he would only go so far as to say there was, quote, some grounds for optimism that a soft landing could be achieved. And Kansas City Fed President Esther George said yesterday, quote, a soft landing is possible but not guaranteed. She warned of tougher policies if inflation does not come down. And Philly Fed President Patrick Harker telling CNBC, quote, there may be bumps when we get into a period of below trend growth for a while. He forecast a safe but not necessarily a soft landing. Now, Powell and other Fed officials have said they think the economy is strong enough to withstand rate hikes, along with, of course, the labor market. But for Fed officials, there's a series of unknowns that cloud the outlook of whether they will purposely have to tighten policy so much as to push the economy into recession. Here are some of those unknowns. Is raising the nominal rate enough, or as Larry Summers has suggested, does it have to be the real yield? And that means it would have to go up by, I don't know, to 3 or 4%, according to Summers. Balance sheet reduction, what will that do versus rate hikes in terms of restraining the economy? And of course, is the change sufficient? In other words, the Fed is raising by a lot, but does it need to get to a certain level? Is the change sufficient to restrain the economy? The road to a soft landing, well, it begins with unclogging the traffic jam in the supply chain. It includes bringing workers back into the labor force to avoid a wage price spiral and the runoff of fiscal stimulus. Even then, not clear that 8 rate hikes built in this year and balance sheet reduction will be enough to corral inflation without a recession next year. And I think that's part, Joe, of the Fed's own lack of certainty.
All right, Steve, so we know what 3 top things tomorrow. I think we talked about it a little bit yesterday. Participation rate, I'm interested in. Wage gains, interested in that. And you say we may not see them yet, right?
See what? Sorry,
to the extent
the wage gains yet?
The extent that we could get in relation to, reacting to inflation and needing more, to bring people back.
No, I don't. Some of it may be there, Joe, but let's not lose focus on the headline number, by the way, which is the fact that people come to work. A lot of talk about the idea that wages aren't keeping up with inflation.
Right.
It's important, but it's way more important to have a job whose wage can or cannot go up with inflation than it is not that, if you don't have a job, it doesn't really matter that much. We did put 1 million people back to work in the last 2 months, and I think that's important. And by the way, Joe, in case you're interested, Stella Blues Band, Free Dead in the Park, May 17th. We're playing at the band show in our benefit
Central
for
Park?
Riverkeeper.
Central Park?
The Central Park Band Show, yeah.
Wow.
Yep.
Oh, wow.
The same place the Dead played 50 years ago.
Outside.
May 17th, outside.
Where anything goes. You know what I mean? Outside.
Where anything, well, there's, they have rules. They have rules in the park, Joe. They have rules. You're going to have to behave yourself.
Okay. All right. All right, Steve. I think you wouldn't even have to bring anything there, probably. Just. Coming up, President Biden pledging an additional $500 million in aid to Ukraine. We're going to have the latest on the situation and the progress of ceasefire talks. That's coming next.
President Biden has pledged an additional $500 million in aid to Ukraine. And in a phone call Wednesday, Ukrainian President Zelensky told President Biden that there are positive signals from ongoing negotiations. For more on this, let's bring in Nina Khrushcheva. She is professor of international affairs at the New School and the great-granddaughter of former Soviet Premier Nikita Khrushchev. And Nina, thank you for being here today. You have a very good idea about what may potentially be going through Putin's mind as you understand Russian history and understand what has led up to this. What do you think's happening?
Well, I can't quite say that I have a great idea what's happening in Putin's mind. I think it's only in Putin's mind that geopolitical map that he has may have very little to do with reality, because as you know, the operation that they now call the war, they have been calling the war, was supposed to be done quickly, and now it's 36th day of the operation. It is interesting that President Zelensky says that there is progress, because the Kremlin yesterday came out with a sort of statement that they don't see much change in the Ukrainian attitude towards negotiations. And it is very interesting because it's almost double-headed ego in the Kremlin response, because the head of the negotiation committee, Medinsky, says that there is progress and we are moving forward and we're getting closer, while the Kremlin is downplaying the positive results. So we'll see how the Kremlin is trying to regroup and present it, and basically probably trying to get more out of what is on the table right now for both sides than originally planned.
You point out that to this point, Putin has shown a certain amount of pragmatism, biting off exactly what he can chew and no more. What happened this time?
I think he just got cocky. I think he got away with a lot essentially from, I think, 2016, 2014, the Crimea annexation. Then there was sort of normalization relationship with the West. Then 2015, 2016 American elections, where he got a lot of credit for electing Donald Trump. I don't think he did as much as the Americans say he did, but he was happily, being a former KGB agent, really took credit for this. And then there was war in Syria where they claimed success. So he just thought that he can do everything. I mean, after 22 years in power, 22 years in the Kremlin, absolute power corrupts absolutely. So I think it completely got into his head that now he can just take over territories in Europe, and everybody would be in the decadent West, as they say, with its own problems and its own conflicts, just will not be able to put up a defense. And so that's why I believe that he just decided that he can bite off the whole world, essentially, to stand up and fight for the Russian place equal to the American place in the world with the rest of the world.
You know, I've heard a lot of people analyze what happened in the Cuban Missile Crisis with your great-grandfather and Kennedy, and the idea that they were able to reach negotiation where they both kind of got what they wanted. But I've also heard that, you know, Khrushchev actually allowed Kennedy to go out and campaign on that and make a big deal about what he had done, and let him take a lot of the credit for that. It's probably part of the reason that we were able to reach an agreement like that. How do you see something like this? Because that seems like a much more difficult circumstance. Like, those sort of circumstances don't exist today. I can't see Putin allowing that, and it's kind of hard to see Joe Biden allowing that too.
Absolutely, and you know, you don't even need my answer. You already, as Mikhail Gorbachev, the last Soviet president, said, in your question there is an answer. You just answered it. I think these people, they really understood. I mean, both of them fought in the war, Kennedy and Khrushchev. They knew what the war was, so they absolutely were not going to let the war happen. That was a given on both sides. So they had more humanity and more understanding of what it means to fight against each other. And I don't think that that's happening. Certainly not in Putin's mind. I mean, he talks about the war all the time, and yet he began the war, and they're not even calling it the war. It's like a special operation, which is completely inconceivable if you see footage from from Ukraine of how Russia is destroying that neighboring country. So I think that the time when 70 years, 75 years since the war, it's just unfortunately the memory faded, and it's all about heroism. It's not about the suffering, and it doesn't seem that that Putin understands that. And also, what you asked previously, what why is he so reckless this time around? And it does seem, I mean, there's a lot of comparison with Khrushchev. That Khrushchev was enthusiastic about certain things. He was not even killed. He could get excited. He could get kind of way ahead of himself and be very unpredictable. I'm looking at Putin right now and think, well, Khrushchev was very zen in his political decisions, which is a lot to say.
Nina, is there anything to the notion that the West would be doing something differently in terms of the very wary approach that the West is taking, almost kid gloves, because of what they see as the unpredictability of Putin, and that is handcuffing us from doing what we really should be doing in trying to push back against all of this? It's almost as if we give him leeway because we're worried about what he might do, and puts us in a difficult position to be able to counter what he's doing.
Well, I mean, as President Biden said numerous times, we don't want World War III, and so the question is
again and again, yeah,
right? Do we want World War III? I don't have an answer to that. Whether it should be doing more, I think it's doing. I mean, it is basically an economic war, global economic war on Russia right now. So if that is not enough, then there's bombs and nuclear weapons. So we're going back to the 50s. And I don't know that is a great solution. What I do find very unfortunate that in 2014, when Crimea was annexed, and I was one of the people, and there were some people arguing that this kind of sanctions that they are now should have been done then, because that certainly would have stopped Putin, and also his security apparatus, his military apparatus, his own mind wasn't prepared to be completely cut off from the West. But in 8 years, I think the process has been going on to really reduce Russian dependence on anything, but also reduce the Russian civil society from reacting from what's going on. So I think 8 years in this sense were completely lost, and that should really be a lesson to the world in the future.
Nina, thank you very much for joining us.
Thank you.
Coming up, a closer look at Apple's streaming strategy after it wins big at the Oscars. Our John Fort will join us in a couple of minutes to discuss. And we're on yield curve watch again this morning. We'll take a closer look at the potential inversion between the rate on the 2-year and the 10-year. Before we head to break, let's get a check on the markets. About where they've been, a little red on the Dow, and now the S&P. NASDAQ's still holding on to slim gains. Squawk Box will be right back.
Welcome back to Squawk Box, everybody. In our headlines this morning, President Biden is set to speak this afternoon on the administration's efforts to try and cut rising gas prices. Sources tell NBC News that the White House is considering a plan to release 1 million barrels a day from the Strategic Petroleum Reserve for several months. The CDC has withdrawn its COVID-19 warnings against cruise travel, saying passengers can now make their own risk assessments. Its warning level had been at the highest as recently as December, when the CDC advised against taking any cruises. It then reduced that warning level last month. And vote counting will begin today in 2 union elections involving Amazon warehouses. Voting took place yesterday in New York, Staten Island, and in Alabama. Workers in Alabama were actually voting for the second time after the National Labor Relations Board ruled that Amazon had interfered in that initial vote. When we come back, former White House Chief of Staff and OMB Director Mick Mulvaney will join us to talk about the President Biden's billionaires tax. And then what investors need to know about the bond market's recession signal as the 2-year and the 10-year flirt with inversion. Squawk Box will be right back.
Now for today's Aflac trivia question. What is the worst performing stock in the S&P 500 year to date? The answer when CNBC Squawk Box continues. Now the answer to today's Aflac trivia question. What is the worst performing stock in the S&P 500 year to date? The answer, EPAM Systems.
Big moment for streaming at the Academy Awards this week as Coda took home Best Picture and Apple TV Plus got bragging rights as the first streamer to capture Hollywood's highest honor. So does the Apple win vindicate its business strategy. John Fort is here to weigh in. I don't know, maybe $3 trillion vindicates its business strategy, John.
Morning. Joe, no, it doesn't. I mean, Coda's a great movie. I'm glad Apple paid a record $25 million for the distribution rights out of Sundance. And hey, Apple's Ted Lasso won the Emmy for Outstanding Comedy Series in 2021, too. But this is about business, and it's not really clear what Apple's strategic business goals are with video. And that's a problem. Now, Apple's certainly spending less than its rivals in the space. Amazon paid $8.5 billion for MGM. Netflix spent $17 billion on content overall in 2021. But if Apple wants people to subscribe to Apple TV Plus, I'm not sure that's happening because of this win. Now, a report from Deloitte this week showed that lots of subscribers sign up for streaming services just to watch particular pieces of content, then cancel. And as inflation spikes, consumers increasingly want ad-supported options that are cheaper or free. So is Apple's goal to sell more $200 Apple TV boxes? Well, Coda isn't going to do that any better than just having the best software for streaming would. So Apple's making good choices when it buys movies and TV shows, but that isn't the question. The question is whether Apple should be buying movies and TV shows at all. And this level of spending, even with some Oscars and Emmys, won't make Apple a dominant player in Hollywood. But it might distract them from areas like augmented reality games where they really could break new ground, Joe.
There's no way that you have another side to this. That was so definitive. You really, you know what? You're a conflicted individual if you can come up with it on this one.
Well, there are lots of us in the world, Joe. But you know, on the other hand,
okay, try it.
This Oscar is huge for Apple and for its business. Now, it's too simple to say this is just about getting more Apple TV Plus subscribers or selling more Apple TV boxes. The content is about keeping consumers in an ecosystem. Apple needs for its platforms to offer the best streaming experience because that's how we watch now, on digital screens through wireless connections. And the only way for Apple to gain a durable advantage in this era is to own some of the best content and get access to important relationships in Hollywood. So by having skin in the game, Apple can understand the tools, the technical limitations in premium content, and how to move the whole industry forward. And plus, each individual hit adds up. People watch Ted Lasso and the season ends, so they think they might cancel, but nope, here's this Coda movie. Maybe they keep subscribing. It's not necessarily about owning a whole library of content. It's about having enough of the right movies and shows and streaming music and fitness trainers that customers want to stick around in Apple subscriptions. Now, if Apple didn't invest in content, it could end up in a world where its competitors have the shows people want exclusively on their platforms, and that would make Apple's devices less valuable, Joe.
All right, all right. So do you really have a preference on which OTOH? I mean, what do you really think for? Then I want to ask you about Coda, and I want to ask, did you see Coda yet?
I did. It really is fantastic.
Oh my God, I know. I saw it twice.
Yeah.
Did you cry like a baby?
I cried like a toddler, probably, who's trying to hold it back at times. I wasn't like
right.
completely.
I didn't weep, but I was embarrassed with other people.
I felt good about crying. You know, I went to high school with a great guy, Tyrone Giordano. He's a deaf actor, and so I've been paying attention to that space more because of the personal connection. You know, he's a great guy, and this
you don't need to
movie's
speak to act, John. You don't need to speak. We know that now after the best supporting.
Everybody should see it.
How about you should now? Okay, so I don't know how much time we have. How about Power of the Dog?
I have not seen Power of the Dog.
Okay. Because I think that there should have been two best pictures, maybe. I understand those that said the genius and the cinematography in Jane Campion and the way that it was done. I understand how you could say, you know what, Coda was. Every once in a while, a movie like that comes along, John, it's almost life-affirming and life-changing. And it may not be artistically the most incredible, you know, Orson Welles directed piece, but it's so significant that you need to see its best picture.
Question,
and then on the other hand, maybe Power of the Dog. I'm doing it on the other hand.
I love it. But are you a long-term subscriber to Apple TV Plus, or did you just borrow a subscription to watch it?
I have Apple TV. That's how I get to all my apps. That's how I get the Hulu. That's how I get the.
But you're paying for
Peacock.
Plus.
I'm mostly on Peacock. I'm mostly on Peacock. 99% of the time.
The world is going to Peacock. TM.
Speaking of peacocks, the coach did go to Seton Hall. Did you see that? Shaheen.
No.
Yes, exactly what I said. He was already signed on. It's okay. He was 4 years. He was a great player.
Yeah.
All right, Fort, thank you.
Speaking of peacocks, Becky, you have the tease.
Right.
Still to come, former White House Chief of Staff Mick Mulvaney. Stay tuned, you're watching Squawk Box, and this is CNBC.
Senator Joe Manchin of West Virginia is critical of President Biden's budget plan and so-called billionaire's tax. And without his support, does this mean the president's budget deal is dead, or at least that part of it? Let's bring in Mick Mulvaney, who formerly served in the Trump administration as OMB director and White House chief of staff. He's now co-chair of Actum Consulting. And Mick, thanks for joining us. Is this a productive use of our time, do you think? We had this, I'll tell you what I'm talking about. We had this conversation earlier this week. I'm told that we need to have the conversation of how to do this, because what is the chance that this becomes law, Mick, in your view, just a realistic view, and maybe we're both biased on how we see things, but I'm not even sure it passes constitutional muster, much less has any chance of getting voted on by the current Congress.
Yeah, Joe, good morning. Thanks for having me as always. Two answers to that question. At the practical level, no, you're wasting your time talking about it because it's never going to happen. The president's budget is not a piece of legislation. In fact, it's not a law at all. It's a proposal. It probably will never even be voted on in any way, shape, or form. I cannot remember the last time that any president's budget actually passed through the House or the Senate. And even if it did, it's a resolution, not a law. So it doesn't happen. So practically speaking, no. But on the other hand, it does matter from a philosophical sort of ideological discussion, because this is an idea document. It's a messaging document. It's the way the president would make the economy, would make the country if he could wave a magic wand on his own. So I think it is right to have a I about whether or not the politics of envy is important, because that's what I think.
Who's winning the argument? Why propose something if it's I guess I feel a certain way, so maybe I'm not stop the presses. Maybe I'm not objective about analyzing this thing, but it seems to me, I don't know, I asked someone earlier today, is it playing in Peoria? Do the vast majority of Americans see this and go, doggone it, I wish we could do this. Maybe we can't, but sure seems like a great idea. Is that what do you think that that's where we are in this country now?
I think it's the Democrats, the Biden administration, sort of giving the far left what they wanted, what they thought they got when they voted for Joe Biden, which is go out and soak the rich. I don't think you'll see even much discussion about this, Joe, because once you start getting into the details, it becomes really, really oppressive on folks in Peoria. Keep in mind, the threshold here is $100 million, which sounds like it only applies to 700 families, and it really does, until you realize everybody's going to have to prove that they aren't worth $100 million. So everybody who files is going to have to do something to prove that they're not in that 1/100th of 1% of the top wealthiest families in the country. So it falls apart once you start to take a look at it. And for that reason, I don't think anybody's going to take a look at it very closely.
We had Senator Elizabeth Warren on, and she has...
And she loved it.
Yeah, but she's makes a lot of hay about firemen and public school teachers paying higher taxes than these horrible, wealthy billionaires and 100 millionaires. Who is that? So that, how does that help her? Does it help her fundraise?
Listen, I think the best question to ask Senator Warren, if she's on there, anybody on the left, is whenever it's easy to sell some of their ideas. Make the rich pay their fair share. It's so easy to say, it's so easy to sort of think about, and it's so lovely, right? Everybody should pay their fair share. The question should be, what's the fair share? The last time I looked, and now it's been about a year since I've looked at it, the top 1% paid about 20% of all taxes. Half of the country didn't pay any income taxes at all. They don't pay for the national defense, for example. Half the country doesn't pay for that. The rich are already carrying this country. So I think it's a question to ask Elizabeth Warren, proponents of folks who like this budget, what is the fair share? What percentage of income tax should be paid by the rich? That's a conversation that should happen, but it's not going to happen because of this budget.
40% anyway. It's not 20%.
Is it 40?
It's 40. And then the top 10 is, what, 75 or something?
Yeah, but Mick, it does get at the idea of kind of combining what high taxes are for the wealthy who are paying large amounts, and then there are a class of a few billionaires who are getting away with much lower rates, in some cases 4%, 5%, even less than that. And that's probably what people come back to. Look, what they're talking about when she calls it a billionaire income tax, it's not. It's not a proper terminology because this is not an income tax. This is a wealth tax. But maybe there is something in kind of trying to get at that anger for feeling like people aren't paying their fair share. If you find out that somebody's paying 50% or more of their taxes and federal and state taxes and local taxes, then yeah, that seems like a very fair share. If you find out somebody who's a billionaire is paying less than 5% or in some cases less than 4 or 3%, then that kind of is where you get at that inequity argument.
Yeah, and if you want to drill down into the equity argument, equity is always a difficult word because it means different things to different people. I kind of like the word equality because I know what that means. What might be equitable to you, it might not be equitable to me. But if you want to drill down to the super wealthy who don't ever cash in their stock, so they don't have any income, they borrow money, they deduct the interest that they're using for the money to live off of it, and they die and they pass those assets on to their heirs on tax, and they get a step up in basis. Yeah, that's a system that probably could bear some scrutiny. Maybe the step up in basis is something I've always thought, does that really make any sense? There could be some fundamental things there that could form the basis of a compromise, but a wealth tax is just the politics of envy. And listen, we sit here and every single time we talk about how divided the nation is, this proposal doesn't really unite the nation. In fact, it probably makes it even worse.
So Mick, you know about budgets, OMB director. You saw the article in the Journal about how the tax receipts coming in, the economy's rocking, inflation actually helps in terms of taxes that are being paid. Should we be able to live on what we're pulling in right now? And we need to decide how to split it up to get our priorities straight. Maybe our priorities are all messed up. Do we need to do something with non-discretionary spending so we can spend it on schools or I don't know, preschool? I don't know. What should we do? instead of
what
just
you
trying to raise more money and blow that.
what you just described, prioritizing and weighing the positives and benefits and the costs and the benefits, describes what happens in almost every single state. State government actually works a little bit. The federal government is different. And no, what you've just described is never going to happen. And here's why. If you owned a printing press, it was in your basement, and you were able to use it whenever you wanted to, and you really believed that using it every single day wouldn't have any negative effect on any of your friends or family or the nation, would you use that printing press? The answer is yes, you would. And that's what Washington does. They do not believe there's any negative impact to long-term deficits. They don't believe there's any negative impact to long-term debts. Even many Republicans who say they're fiscally conservative magically become less so once there's a Republican president in office. The fiscal conservative wing of Washington, D.C. is getting smaller every single year. So, yeah, we should do those things, but we're not going to. So the question then becomes, how do we function?
What about a consumption tax? Would billionaires who they do live well. It's up Gates's new house down in San Diego. Is there a way to, tax a 600-foot yacht?
Sure, you could do consumption taxes. You can do flat taxes. You talk about percentage rates. I've never looked at the percentage rate.
Why isn't that popular? Why don't we ever hear that from Democrats?
We don't hear from anybody, and here's why, or at least anybody who's serious about it or has a chance to get done. And here's why: if you're paying $0 in tax today and you pay $1 in tax tomorrow, that's an infinite percentage increase in your tax burden. And that's really hard to run on when the other side is going to go and say, you've just proposed the largest income tax or flat tax or whatever in history. It's hard to do politically. When Rick Scott came out and said everybody should have a little bit of skin in the game, he got excoriated for that. If I come on TV and say everybody should pay $1 for defense, I'll be attacked as being the biggest tax and spender in the country. It's really difficult to do these things politically.
Are you allowed to come on if you're like a big time CBS person? Are you still allowed to come on Squawk Box? Do you know?
Every now and then. If you don't talk about budgets, that's fine. I don't have to wear a tie for them in the morning, but
we could have gotten you.
You could have hired me, and you chose not to, and that's fine.
I think it's obvious. I think it's obvious why. Anyway, Nick, thank you. It's good to have you on. I'm just kidding. All right, see you later.
Before we head to a break, a couple of stocks to watch. Walgreens beating on both the top and the bottom line with adjusted earnings of $1.59 a share. Street was only looking for $1.40. It came in with revenue of $33.8 billion versus $33.4 billion in terms of expectations. That stock, though, is still down by about 1.1%. And Advanced Micro Devices downgraded to equal weight from overweight at Barclays. They point to cyclical risk in several different end markets for the semiconductor maker. That stock right now off by about 2%. Squawk Box will be right back.
smug. A trade association that says it supports small business and advocates against antitrust and regulations is apparently backed by two of the biggest tech companies on the planet. You don't say. Eamon Javers, or you do say, joins us now with more on that story. Hey, Eamon.
You do say, yeah, Joe. Good morning. A Washington, D.C. nonprofit group called the Connected Commerce Council, or 3C, describes itself as a membership organization that advocates on behalf of small business on technology issues. And until recently, the group had a list of those members displayed on its website. But when CNBC called the small businesses that were listed there, more than 20 of them told us they weren't actually members or had never heard of the group. Other members we talked to did say they're active participants in the group. Now, critics say the council is an AstroTurf lobbying group. Now, that's a bit of Washington slang for a group that claims to represent grassroots entities, but in reality serves as an advocate for big industry. In fact, the Connected Commerce Council is financed by Google and Amazon and advocates against antitrust legislation on Capitol Hill and in a Facebook advertising campaign. Amazon and Google are listed as partners on 3C's website. Now, until Monday, the group also listed a third company on its website as a partner, the payments processor Square, which is now known as Block. But when we called them to ask why they're partners with the council, they said, well, they're not. After our inquiry, Block called the council to ask that the Square logo be removed from its website, which it was on Monday. In a statement, the council's executive director said all of its members affirmatively sign up at events online or through a personal connection. And he said small businesses have legitimate concerns. He denied that the group is an AstroTurf organization. Now, to be sure, the group does have small business members who told us they're happy with the council and agree with its advocacy on antitrust issues. The group has thrown happy hours for members and offers training on tech tools. In a statement, Google said, "We encourage concerned businesses and organizations that represent them to ask Congress to consider the unintended consequences of these bills for small business across the country." An Amazon official confirmed that the company is a partner of the council. Neither company would say how much money, if any, it contributed to the group. Back over to you guys.
Wow. Very good, Eamon. Very interesting. Thank you. Appreciate that report. Back.
Still to come this morning, is China manipulating the oil market? Kyle Bass of Heyman Capital believes that could be the case. He'll join us to explain why. Check it out right now. S&P futures flat, Dow futures off by about 26, the NASDAQ up by about 28. Squawk Box will be right back. Welcome back, everybody. Fixed income investors are keeping a pretty careful watch on bond spreads after the 5- and 30-year rates flipped earlier this week. And although it's not gospel, yield curve inversions historically occur before a recession. Joining us right now to weigh in on what might be coming are Anthony Woodside. He is senior strategist for active fixed income at LGIM America. Also with us, Steve Leisman and Rick Santelli, who's here with us as well. And guys, I just want to start with this whole debate. I was out yesterday. I know there was this back and forth about whether the 10 and 2 years inverted. My take is it did not. Rick, we came awfully close to it. Does that count?
Yeah, you know what? I don't know that it counts, and I don't think in the grand scheme of things it's going to make much difference. It will invert. The question is what does it mean? And I would state it as follows. If you have a cold, you sneeze. But if you sneeze, you don't necessarily have a cold. Whether you look at the 90-91 recession, the 2001, the 08-09, or the 2020, in every case, 2s to 10s inverted prior. But also 3 months to 10s inverted prior as well. And my argument would be all yield curves inverting potentially can lead to recession. But since 3 months to 10s is so steep and 2s to 10s isn't, I would just stick probably with the lowest common denominator, because in every instance of recent recessions, 3 months to 10s did invert and a recession did occur.
All right, that's a fair point. Steve, you want to explain it a little bit about why this is a signal of a recession, what it's telling us?
It tells you that the Fed is raising rates, and the markets believe down the road the Fed will likely go too far and have to cut rates, and going too far means it's in a recession. I actually, if you know, I guess different strokes for different folks here. I like the 3-month, 2-year spread, and the reason is because it's in the window you're trying to forecast. I get the idea that the 210 has this very good record, although there's a question about its record in 2019, in my opinion, because the inference in 2019 is that it somehow foresaw the COVID outbreak, which doesn't make a whole lot of sense. That said, I like the 2-month, 3-year. That shows you it is really spiking right now, kind of along the lines of what Rick was talking about. It's just a nearer term spread, and it's within the zone that you're trying to forecast. You want to know what's going to happen in the next couple of years. Not entirely clear to me why the 10-year would be giving you that kind of information.
Hey, Anthony, we have seen a significant move in rates. It's something that everybody's watching, paying attention to. You think that the move we've seen to this point is an accurate reflection of what's happening in the economy and what's expected to come from the Fed?
Yeah, we do think that this is an accurate reflection. We think that rates and the Fed were particularly behind the curve when you compare it to the economic realities on the ground. We have a hot labor market, inflation running at 40-year highs. So we thought that the yield environment that was pervasive in 2021 was too low. And now you're seeing investors and the Fed itself catch up to economic reality. The bottom line is that you need significant amount of monetary policy tightening if you're going to corral rising inflationary pressures here. And we think that right now, given that the market is pricing for 8.22, we think that's a more realistic scenario of what's going on.
So, Anthony, what would you tell people to do right now when it comes to anything in the bond market? What do you like? What do you not like?
Yeah, so I think the prevailing message we would tell investors is to sell into strength. You've seen a rally in risk in the last few weeks here, and we're using the opportunity to go up in quality in our credit portfolios. More particularly, we're rotating out of single B names and into triple B names and into single A names here. We're rotating into defensive sectors like pharmaceuticals and utilities that should be able to withstand a slowdown in the economy or withstand increased volatility from the tightening cycle that we are about to see. So that's some of the things that we are thinking about in our portfolios.
Hey, Steve, what's the idea that you get, the sense you get of how Powell and company are reading these moves in the bond market?
You know, I think they look at a lot of things, and it really is an interesting question, because the issue is where and what is tightening in terms of financial conditions. I think they look at spreads, and spreads have been wider. I think they look at these when I say spreads, I mean spreads of, for example, triple B or corporate bonds to risk-free notes. They see tightening there. They see the market being down. They see some tightening there. And of course, they see the outlook for rate hikes for the Fed funds futures being higher, and they see tightening there. In fact, it's pretty interesting, Becky. The Fed has raised by 1/4 of a point, and there's something like 200 bases of tightening already in the 2-year. So the Fed is broadly watching financial conditions to see if its words are being transmitted into reality, into the real economy. And that does seem to be happening now.
Hey, Rick, I think you've kind of set the tone with just saying just because you sneeze doesn't mean you have a cold.
Such a good saying. Where does it come up with that stuff?
It's a good way of kind of setting the tone on this. And by the way, just because you sneeze or just because you get a cold doesn't mean you have COVID or the flu. And maybe we should be thinking about that too. Just because you get a recession, that just means 2 quarters in a row of negative growth. That's not necessarily a recipe for disaster, right?
No, as a matter of fact, the truth be told, and I know everybody's head's going to explode with this, but from Greenspan on, central bankers around the globe, especially the Fed, have been trying to wean out the whole recessionary process by easy money and artificially low interest rates. Recessions are a cleansing process. I think it's very necessary. I know it can cause pain, and I'm not necessarily hoping it occurs, but it really isn't the end of the world. And I think those types of cycles every now and again really keep the system much more honest, and they probably also keep us from having the big one somewhere down the road.
I'm thinking of a juicing detox. You know, not comfortable, but sometimes necessary. Little maintenance coming through. Thank you, gentlemen. It is good to see all of you. Anthony, Steve, and Rick. It's just after 8 a.m. in New York, and you're watching Squawk Box live from the NASDAQ market site in Times Square. I'm Becky Quick, along with Joe Kernan. Andrew is off today. Futures this morning have been a little bit of a mixed picture. Dow futures down by about 18 points. S&P futures up by less than 2 points, and then the NASDAQ up by about 43. We've got some great guests still to come in the next hour, including Congressman Josh Gottheimer of the Problem Solvers Caucus. He's going to
roughly 2 days of global demand, and as mentioned, in a near 50-year history of the SPR. Now, news of the potential oil release comes as OPEC Plus's meeting today. They're expected to announce plans to proceed with small production increases. And, well, we also had some numbers out overnight worth mention, well, and one this morning ahead of the cash open. Let's begin with the data out of China. First and foremost, take a look. The composite PMI slipping to 48.8 from 51.2 prior, slipping below that expansion contraction level, as was the case with the manufacturing PMI to 49.5 from 50.2, below expectations for 49.9. And take a look, the non-manufacturing PMI also, again, coming in below 50. Now, keep in mind, this report, those numbers here, the actually survey was closed a few days before Shanghai's lockdown, so that's expected to only get worse. And in addition to that, we also have the Challenger job cut report, which take a look at 21,387. Well, that came in up 40% from February. Year over year, that number was down 30.1% though. So again, some data overnight I wanted to bring to your attention. Let's dive into some charts and take a look at what's going on here this morning ahead of the cash open in the ES. Fractionally higher, as you can see, and very much range bound in the overnight session. I want to direct your eye to this dark shaded area first and foremost. It's the day session trade from yesterday. You can see how well we kind of sold off throughout the day down into and below that 4,600 level, but rallied right back to it into the close. You can see we've been kind of hovering, teetering around that key psychological level that we managed to get up above this week. I want to point out here, again, not a lot of directional conviction yesterday for that matter, or in the overnight session as we hold near these March highs and, well, just above the Feb highs. Take a look at the Dow, a very similar pattern, selling off throughout the day. Large caps rallied back into the close, though. They've been holding above 35,000 here. A brief visit below it yesterday, but again, in the overnight, just kind of teetering in the middle of the range that we established yesterday. A very similar pattern playing out in the NASDAQ as it's been holding above 15,000. And the Russell briefly, well, I should say holding back below 2,100 now after briefly getting it back above it this week. Now, let's step back from that hourly, or I'm sorry, 5-minute time frame and take a look at the 30, because a couple different looks at recent price activity. First and foremost, the rally we've seen throughout the month of March. You can see the run up and how we're holding near the highs of the month as we head into the last trading day of the quarter. take a look. I also want to point out here, though, this is the hourly time frame and how in the month of March we managed to take out those Feb highs. Here's a look at the Jan high. That's the all-time high, if you remember, up at 48.08. But notice here again, 41.01 was the lows that we saw in February. In March, we were unable to take out that low. Now, I do want to remind everybody the NASDAQ did take out the Feb low in the month of March, but it was the only one of the four majors that was able to do so, and we rallied significantly off those lower levels over the last couple weeks, a big move up. Take a look at where things stand now in terms of the 50-day moving average. The ES, a good representation of all four of the majors. The ES, the NASDAQ, the Dow, the Russell, comfortably above the 50-day moving average now with that move up we've seen throughout the month of March. And then, hey, the ES, the NASDAQ, and the Dow are also either at or, in this instance, you can see above the 200-day moving average. And again, the three now at or above that key level. But take a look at the outlier, the Russell, small cap, still holding below the 200-day moving average. It's about 100 points above where we are right now. I just want to point out the VIX, we saw a nice move up this month. Again, another higher high and a higher low, just barely squeaking out a higher low, assuming we stay above that Feb low. It looks like we will into the end of the month here today. But yeah, I also just want to point out real quick, now that I think of it, we actually took out that Feb high. And then again, you can see as the indices rallied back throughout the month of March, look at what happened to the VIX. It came off quite swiftly. Okay, that's a good look at top stories, where things stand ahead of the cash open in terms of what's on the minds of traders and investors, a few levels that you should be keeping an eye on in the indices. Let's get a little bit deeper into what's playing out in terms of oil and the energy markets this morning with the news today. I have just the person to help us with that. Wayne Kaufman, the chief market analyst at Phoenix Financial Services, joins us. Wayne, it's good to have you with us this morning. I wanted to talk commodities here, and timely conversation, I guess, considering the news. Just started off the show, we were talking about the White House expected to announce a massive release of the SPRs, 1 million barrels per day for months, in total some 180 million barrels. What are you hearing in terms of the details?
Well, first of all, thanks for having me. Great to see you. I think this whole episode, everything that's going on in energy markets around the world, just highlights terrible governmental policies or lack of. There's just no strategies, and we're going from crisis to crisis. And I think there's really no plan. So there's so many contradictions for what's going on in the energy market today. So, as you know, strategic reserve, they're going to release X amount, and the price of oil is down by a commensurate percentage based on the amount of oil we produce and the demand for oil here. So that 5.5% or so, that's just a pure mathematical number. But longer term, the government is concerned about the price of gasoline, and they should be. So there's a movement to give people to cut taxes, to remove taxes on oil, on gasoline. So what is that going to do? That's going to increase demand. In the meantime, we're going to release reserves from the strategic reserve. We're going to put out an enormous amount. And what is that going to do? Well, it's going to lower prices for oil. Well, that's good, except we've seen over the last few years that our oil producers have had tremendous discipline in terms of what they've been doing. That conceivably will reduce supply, because if you're a producer and now you're seeing lower prices, are you going to race to increase supply? So it's a little bit contradictory. And at the same time, we're seeing demand is coming back, but supply is not increasing due to all these disruptions that we've been seeing around the world. And the Biden administration, initially, they were reaching out to Venezuela, Saudi Arabia, maybe even trying to push an Iran deal so they can get more Iranian oil on the market, not reaching out to domestic producers. And it just creates a look of a helter-skelter type of strategy, or no strategy. So it's really an amazing situation. It's hard for everybody to get their heads really wrapped around it.
Helter-skelter strategy, and in many ways kind of not much in terms of reaction to. We oftentimes see the market react, but it's oftentimes short-term, I guess, easing of some of the price pressures is my point. Now, I think you bring up a good point in terms of it does seem like they're hopping from crisis to crisis, but kind of in their defense, I mean, nobody could have predicted COVID. Nobody could have predicted the Russian attack on Ukraine. So these are circumstantial events that they've had to just sort of deal with on a daily basis. But I think you're right. And we talked about how cutting the taxes actually does increase demand and potentially ultimately prices at the pump. We've seen many studies point to demand coming back is the question I had at this point because well, before we get into demand coming back, now they think of it in terms of China and some of the disappointing numbers we talked about at the top of the show as well, and potential for slowing there demand-wise. But I guess the question now being, as far as it's not just the U.S., but the IEA also announcing or expecting to announce this kind of concerted effort. I guess I wonder this time around, would it be a little bit more effective and possibly longer lasting if it's a more kind of a little bit more conformity to it just not being the U.S., simply put?
Sure. If you've got an enormous amount of parties acting in concert, that will have a short-term effect. Longer term, you know, you say in their defense, nobody could have forecast Ukraine, nobody could have forecast COVID. The problem is we never know what the next issue is going to be. The key point is, have their policies left us vulnerable for when these issues pop up? And that's what we're seeing over in Europe. The European governments have been terrible on this also. Look how they left themselves vulnerable to Vladimir Putin. That's the point.
Yep.
We can never see what these events are going to be, but we can see if we're leaving ourselves vulnerable. And the movement here in the United States against any and all types of carbon assets. We know that some people, a lot of these politicians, they have utopian points of view. They think, okay, carbon is a pollutant. It's bad for the environment. Let's get rid of it now. Let's just immediately go to alternative sources. But they never really look at the numbers. The numbers don't add up. And they've never come up with a plan for getting from point A to point B. That's really what I was saying. You're right. We couldn't afford.
I think you bring up a good point there, and Wayne, I completely agree with you in terms of that. I mean, I was shocked throughout the pandemic that the CDC and some of these organizations didn't have some sort of a mapped out plan under these circumstances that we would follow. It did seem like they were kind of coming up along the ways or every day with a new type of roadmap throughout the process. But okay, along those lines here now, in terms of, I mean, one thing, well, speaking to that point, I mean, is the solution here, is it more domestic energy production? Is the Biden administration kind of revisiting some of their approaches towards supporting some of those initiatives?
I don't think they are. And I think that that is the solution. Okay. It was just a few years ago, we were energy independent. Yeah. Now we're not, and everybody knows famously that we have actually been buying oil from Russia. So it's just, to me, we want to be energy independent. We have to have a real plan. You know, Jamie Dimon said we need a Marshall Plan for energy. He's 100% right. I'm not sure the details of what he's calling for, but we just do not seem to have an integrated plan for how do we supply the country with the energy that we need to keep growing, while at the same time having an intelligent roadmap to transitioning away from the carbon assets. I don't think, you know, if it's out there, so please somebody let me know, because I've missed it.
No, you bring up a great plan. I mean, some people would point to green energy, but that seems to be years, if not decades away before we can have that reliance and that independence based on. But, you know, your comments here daunting in many ways when you consider, I mean, it was just yesterday we were hearing about potential for natural gas rations in Europe.
Well, you know, again, over in Europe, they've just done a terrible thing. And this is not new. Governments around the world have always been wrong when it comes to energy. You know, we talk a lot about coal production and coal usage here for utilities to create energy. You know, a lot of the electricity plants are coal-fired. People don't know this, but the reason that so many of them use coal, and now we've been going away from coal and going to natural gas, is that in the 1970s, our government decided that we were going to run out of natural gas and they passed regulations that you couldn't build new electricity plants based on natural gas. You had to use it on coal. So look how wrong they got it then. I think the problem, to me, the whole problem, this is a big statement, but you've got a failure of government all around the world on so many issues. Energy is just one of the issues of the failure of government around the world. I don't have the answers for it, but they're not acting like business people. They just go from election to election. They want to buy votes. We'll give money to people so that we get votes, and they're not really solving problems. And in fact, they end up creating more problems longer term.
A fair amount of complacency, to say the least, here. I would agree with you on that front here, and kind of a reflection of, I was looking at gold, it's seen its best quarter, I think the biggest gain since 2020, up 5%. Everybody was a little bit disappointed that it couldn't post a new all-time high up around that 2100 level, but a reflection of maybe investors' unease, some of these geopolitical tensions, and basically what you were speaking to, again, the mismanagement in many ways of circumstances at hand.
We're seeing that all over the commodities markets now, okay? Look what's happening. I know you know, corn, wheat, soybeans, and now they're talking about increasing the amount of soy oil that's going to go into gasoline. So now you're having disruptions in those markets where you're starting to have farmers say, okay, I'll plant a little less corn. Now I'm going to plant some soybeans. So the acreage is moving around. And unfortunately, for the last 3 years or longer, but really since COVID started, we've had nothing but disruptions. People who try and figure out what's going on in markets. I used to use the analogy of the python that swallowed an animal that was too big and it had to work its way through, and that was COVID. And then now we get Ukraine. We just go from disruption to disruption. It makes trend forecasting almost impossible. And now you've got people forecasting that the Fed needs to raise rates at really dramatic levels. They should have started back in January. I was calling for a 50 base hike in January. Now it seems like all of a sudden they woke up, and they may be waking up a little too soon, because as you know, in commodities, they say the cure for high prices is higher prices. Well, people who looked at the conference call for Restoration Hardware yesterday, which was a big deal.
It was an eye-opener, yeah.
It was a huge eye-opener. So now, are we starting to see demand slacken? And if you look at the charts of home builders, of Home Depot, of Lowe's, of the retail, look at the RTH, the other retail ETFs, saying, wow, is this forecasting something bad that's happening with the consumer? The Restoration Hardware CEO, basically, he had some very, very dramatic things to say about prices are going to go higher. Nobody really knows how high these prices can go. And that he was actually wondering if Janet Yellen and the Fed people actually even really talk to business people to find out what they're seeing.
You know, we mentioned some of the disappointing numbers out of China, and just to point here as we say goodbye, it's not just here in the U.S. that we're seeing this. Again, I mentioned the PMI numbers out of China. I'm looking here at the Hong Kong retail sales overnight, year over year, down over 14%, prior reading up 4.1. So it does seem like as a result of the circumstances that, well, consumers have had to shift a bit from the last few months relative to what we'd seen into the end of last year. Wayne, appreciate you joining us here, and a very candid look at what's playing out here recently. Wayne Kaufman, the Chief Market Analyst at Phoenix Financial Services, joining us this morning. And, well, stick around. We're going to take a quick break. Stay right where you are, though. When we come back, Michael Zaremski is going to help us get ahead of a couple of the numbers headed our way. We're talking personal income and spending. We've got jobless claims this morning, and, well, lots more futures after this short break. We'll be back.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy. A measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to the Future Show here on the TD Ameritrade Network. Before the break, we were talking top stories that are moving markets this morning. We took a look at some key levels in the indices. I want to get ahead of some of the economic data that's headed our way in just about 8 minutes. We have Michael Zaremski joining us this morning, the Director of Futures at Charles Schwab. He's here to help us do just that. Michael, good morning to you. Personal income and spending headed our way. Talk to us about what we should be looking for.
Good morning, Ben. Yes, that's probably the highlight number out today besides the core PCE number. And we're expecting moderate increases for both in February, up about 0.5% for personal income as well as spending. Now, we got to know the January number, especially for spending, was up 2.1%. So there's a big spike up as well, too. So we're going to see that get a little bit more calmer here in February, but we also had no increase though in wages in January, so we're seeing a little bit of an uptick as well too. So kind of a Goldilocks figure here, I think, for those numbers. Now, on the inflation side, when we look at the PCE here, we expect to see once again, high inflation levels here from back in the 80s here. The headline number about 6.5% year over year in February, and the core, that's the one that the Fed really looks at, which takes out those volatile food and energy prices there. That's supposed to be about 5.5%. So it's really just kind of keeping things on track here as well, too. We know that prices are higher, inflationary pressures are not subsiding yet as well, too. And we're only seeing moderate increases in income. So it's still that situation there where the Fed is, going to be taking action here to try to get down those high inflation rates.
Yeah, I think it's important. We actually started the show talking about crude oil, how that was the major focal point for investors and traders this morning, and down around 6% right now, still holding above $100 a barrel. So again, I think that's going to shift quickly in about 6 minutes here to the inflation data, from crude again to inflation data. And I think traders will be quickly reminded that crude at $100 a barrel, it really feeds into some of these inflation concerns.
It certainly does, Ben. And if what happens, what they're talking about is true, that the Biden administration is going to be releasing up to maybe 180 million barrels from the Strategic Petroleum Reserve over 6 months' time here as well, too. Yes, that may hamper prices here a little bit in the short term, but if you go looking out, let's go out a year, let's go out 2 years. Eventually, we're going to have to buy back that oil and fill up the reserves again as well, too. So all that's really going to do is kind of set maybe more of a higher floor on oil prices going forward as well, too. So we won't see maybe any dramatic drop downs as well. In fact, the futures markets today are showing that as well, too. If you go out to, let's say, the DEES 2023 contract, we are unchanged to maybe a little bit higher today. So I think this is really just kind of, trying to solve an initial problem now here, but it could lead to, overall higher energy prices going forward.
All right, let's talk about jobless claims. Another week here in terms of the weekly numbers, or another report here in terms of the weekly numbers, but this one gets a little bit overshadowed by tomorrow's larger non-farm payrolls, the monthly data.
Exactly right, Ben. But right now, the jobs data there has been really good. I mean, we got level since 1969 last week here, and we're expected to once again be below 200,000 on the weekly claims here. So yeah, the jobs picture still remains strong. Now, I did notice that in today's Challenger Christmas, their layoffs, I mean, it did kind of spike up there. It was a little bit above expectations there, but you got to remember that the February data was near record lows for that particular indicator there as well too. So I wouldn't really take that as a sign yet that things are starting to worsen, but we start to see this continuing. We start to see the layoffs start to increase, so we start to see a spike up in those weekly jobless claims. Then I would get a little bit more concerned if we're starting to see that slow down as well. But you're right. I think this number is, unless it's a really odd number there, really spike up for some reason out of the ordinary there as well too, I think that'll be pretty much ignored, and traders will be focusing on tomorrow's non-farm payrolls.
Yeah, you know, I'm taking a look at the numbers here. In terms of the Challenger report, I did note up 40% from February, but down 30% year over year. So again, all of this kind of points to what we've heard from Fed Chair Jerome Powell, and even some of the individual Fed speakers this week, kind of suggesting labor conditions remain very tight here in the U.S., but even to the point where some of the Fed speakers this week, we've heard more kind of that lean towards, or a hint that we could possibly see 50 basis points come May.
I think they're kind of setting the market, and the market is prepared for that now as well. I think that's starting to be priced into like Fed fund futures there as well too. So I think the Fed has once again done, I think, a really good job of really kind of gearing the market for what they're going to be doing there as well too. And I think just seeing the Fed speaker, seeing Chairman Powell there as well, really hinting that the Fed needs to take a little bit more aggressive action, that the economy and the labor market can withstand that as well too. I think that's why we've seen even the equity markets react like they did here with this nice rally we've seen in the month of March here as well too, as they're comfortable that, at least for now, that the Fed does have a plan here as well too, and that they are kind of right here, that the market can withstand, you know, a little bit more aggressive tightening here as well too, to really kind of combat inflation, because they really got to get this inflation under control, because if it doesn't there, that's really going to add to even further weakness going down the line as well too. So unless we start to see this economic data here really start to shift as well too, the market's saying that the Fed has a plan there, and so far they're liking what they're hearing.
Yeah, Michael, to your point earlier, I was just looking back at, I remember Donald Trump actually was the kind of quote unquote to the top comment when he was filling strategic petroleum reserves back in the spring of 2020. And as I look back at price at those levels, we were basically trading around $25, $23. So a little bit of a different scenario to fill those SPRs now than it is back then. Lastly, a couple takeaways here. It does seem like, again, while we're kind of waiting on the non-farm payrolls data, today a couple key data points here, and again, sort of feeding into that narrative where this market's been very headline driven.
Exactly right. Now we are at the end of the quarter as well too. We had a good month here for the equity markets here, but we're still down so far in the first quarter there. So maybe a little bit of window dressing here today. But there's one number there we haven't talked about, Ben, that I think traders really kind of keep an eye on, and that's the quarterly grain stocks and prospective plantings number here as well too, because that's really going to tie into some of that food inflation as well. So we're looking for increased acres there for corn and soybeans slightly from last year as well too. If you see those numbers, anything that kind of skews from there, 92 million acres for corn, about 88.7 million acres for soybeans there, that could add a little bit more volatility for the grain markets there. So I think that's one that traders should kind of keep an eye on there as well too, to see if you as farmers there will actually plant more acreage there to take advantage of these higher prices.
All right, I've got the corn, wheat, and beans on my watch list, and our viewers should as well. It sounds like Michael Zaremski, appreciate you joining us here this morning, Director of Futures at Charles Schwab. We're going to take a quick break. Stay right where you are. When we come back, personal income and spending, the numbers are due out. We'll take a look at jobless claims with Dan Deming, the Managing Director at KKM Financial, and market reaction to the numbers. More futures in just 2 minutes.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to the second half of the Futures Show. We're now 60 minutes away from the cash open for stocks on Wall Street. The indices, the futures, they're still kind of suggesting we'll see a mixed open as we head into the last trading day for the first quarter of the year. Now, we're waiting some data to come out here. As we do, let's just check in on where things stand in terms of the indices. You can see, as mentioned, somewhat mixed. The ES holding just below that 4,600 level. The Dow just above 35,000. The NASDAQ's holding 15K, and the Russell below 2,100. Let's check in on the U.S. dollar and some of the other top traded products and products that should be at the top of your watch list as we await the data. And there you can see the dollar holding just above 98. Gold hanging out right around that 1938 level. Not a lot of movement here, again, from where we checked in earlier this morning. We do have numbers out here this morning, and for the most part, it looks like everything's kind of coming in line with expectations. No real big miss one way or the other. We're going to dive into it with Dan Deming. He's the managing director of KCAM Financial. He's with us this morning to help take a look at some of the data. Dan, I'm noticing it looks like on a month-over-month basis, the personal income came in a little bit below expectations. Spending below expectations, income in line. For the most part, some of those inflation components, the core PCE index also in line. The PCE price index, for the most part, talk to me. What are you seeing? It doesn't seem like this one's going to ruffle too many feathers here.
At first blush, Ben, it looks like the market's reacting positively to the news as we're seeing the futures catch a little bit of a bid here after those numbers were rolled out. And as you mentioned, those numbers pretty much in line. I think that's the market will breathe a sigh of relief in any type of in line to below levels from an inflation standpoint. And then it looks like what the market's reacted to as those numbers were coming out here this morning.
Okay, so I think it goes without saying, and to your point, it sounds like the risk here is to the downside in terms of some of the inflation numbers coming in higher than expected.
Right, exactly. Yeah, I think, the market's still certainly focused on inflation, even though it's had a significant run here in March. And I think it's interesting to point out, or it's key to point out, I should say, is that, we did take out those February tops in some of the major indexes as well. So, we are seeing certainly what would appear to be a bit of a reversal here from the first couple of months of price action in the equity markets. And I think that, the market's still trying to wrestle with how the Fed's going to manage the inflation front. And as you and Michael pointed out, I think very accurately, is that, the Fed has telegraphed what appears to be a 50 basis point hike in May. And the market has been able to digest that to this point and reset and be able to find value, I guess, in the equity markets, even with the idea that interest rates are going to move higher. The interesting dynamic that has been discussed heavily and will continue to be discussed heavily is the flattening of the yield curve, and what does that exactly mean moving forward. So I think that, those are the two areas that I'm watching very closely, the flattening yield curve plus the fact that we are seeing the equity markets now, the major indexes taking out those February highs.
And in terms of, and I like your kind of thought there in terms of the market trying to wrestle with some of the idea that rates are going to be on the move higher. And I want to get your thoughts on the yield curve in just a second. But to that point there, the market trying to wrestle with that, but kind of in their corner as far as rooting them on and kind of cheering them along right now. We've got the jobs reports, which have come in as the Fed has pointed to very strong, and labor conditions here in the U.S. are, again, supportive of what we've seen in terms of the indices rallying back. And I think the NASDAQ was the only one of the four majors that in the month of March took out the Feb lows. And as you mentioned, the other four, all four, I should say, have taken out the Feb highs. So again, the jobs and the strong labor conditions here in the U.S. seem to be kind of in the corner of the investors as they wrestle with these higher rates uncertainties.
Yeah, absolutely, Ben. That's one of the mandates the Fed has to operate off of, and they pointed to that they feel that they've met that mandate. So now they got to focus on the other one, which is price stability. And Yeah, as we continue to see the job market, expand, and it's a pretty tight labor market, and that's another thing that's causing the wage inflation. But there is activity, and the Fed has basically indicated that they feel that the economy can handle a series of rate increases at this juncture, given the fact that we continue to see expansion coming out of the pandemic and some of the other issues the markets had to contend with here, either over the last quarter or over the last couple of years. And it looks like investors are getting more and more comfortable with that idea, and the fact that we are going to continue to see economic activity increasing as more and more people are headed back to the office, as continue to see pickup in transportation. All the things that were pretty much really restricted for the last couple of years are slowly starting to show signs of getting back to pre-pandemic levels. And I think that's the other key here, Ben. You hear that term a lot in the last couple of weeks. We're seeing a lot of the data points now that are back to above pre-pandemic levels.
On the other hand, though, Dan, we've got a situation developing in China. We talked about the PMI numbers there overnight. And, I was just hearing this morning about some of the numbers in terms of this new Delta variant B, I think it is, or variant 2, where we're hearing that maybe even New York City is considering going back to mask mandates.
Yeah, I imagine that those discussions will continue to kind of work their way through the themes if we continue to see a flare-up of, a different form of the virus, I suppose. So, yeah, and what is taking place in China right now, it had a significant impact on the commodities market, at least from a short-term perspective. And, so that is something that is out there lurking as a potential inhibitor to some of the trajectory of what the Fed sees as a positive economic structure right now. So, yeah, there's no question that there's still some hurdles to clear. And, honestly, when you look at the velocity of this move recently, it's breathtaking, to say the least. Especially given the fact that interest rates continue to move higher. So that's a unique environment that we haven't really had to contend with when you analyze the market here the last several years. So there's things out there, Ben, that could derail the situation, but you'd have to say if we get through today, relatively unscathed, what appears at the start of the day looks pretty decent, at least initially, that, this is a victory for the economy, for the markets in March, and getting through some of the issues that it's had to contend with to start the year.
I completely agree. And, to your point here, I think that's a good reminder that some of the expectations that some of the demand could slow down amidst the COVID numbers in China, that's also probably adding to crude prices coming off. It's not just the SPRs, as we've been talking about. But to your point, again, there are a lot of hurdles to clear. And as you mentioned, the velocity on the way up, I wasn't sure if you were talking about the indices, as we've seen throughout the month of March, a strong rally up, and we pointed to it at the top of the show. But also, again, you mentioned the rates, which have been on the move higher. We've seen it quite a sharp move in terms of the shorter end. That's got, again, this yield curve inverting, the 210 for the first time. Now, briefly, and we've been talking to our guests about how by no means entrenched inverted, but briefly inverted, signaling or at least raising those recession talks again, which I think were already on the table prior to. But talk to us, because again, it's not just the velocity in terms of the indices, it's the velocity in terms of rates, which you mentioned, and I think you bring up a good point, has been fairly well digested to this point, especially in the NASDAQ. Holding about 15,000.
I know, exactly. Yeah, you would think that, in theory, higher rates would put a headwind into the growth.
In January, February it was, yeah.
And it did to start the year. But, now we're seeing, I guess, what would either be perceived as value hunters or, that maybe that it got overdone, which, as we know, Ben, over the last several years that we've been analyzing this market. I won't say how long I've been around, but I know you've been around almost as long as I have.
I've seen it once or twice.
We've seen this once or twice, exactly. So, and the markets have a tendency to overreact on the downside, and they have a tendency to overreact on the upside. So, that's the themes that are the market's kind of, wavering here. And whenever you come out of a volatility event like that we realized here earlier this year, there's always going to be those extremes as the market slowly starts to find some equilibrium. But talking about the yield curve, the one thing I find interesting, and the one thing that it's going to be, I think, a dynamic that the market's going to have to contend with, is it continues to creep closer and closer to the short end of the curve. At some point, I know right now the Fed says basically even the 210. I think Chairman Powell said, that's okay. Yeah, that can happen, but that's still 2 years out. Is still plenty of time a lot of things can change, and we have seen over the last few years when we've had these near yield curve inversions or had them inverted for a little while. Usually the scenario that the market was pricing in maybe 3 or 4 years down the road doesn't necessarily take place because there's a lot of moving parts that could change before that period. That's just what it sees at this current trajectory. So I think that that's something that's interesting. But as we've been watching and as you've been talking about over the last couple of months, that it is creeping closer and closer to the short end of the curve. So the closer it gets, the more dangerous it gets from the fact that it could actually be a significant harbinger to economic slowdown or stagflation or any of those narratives. So that's something the market's certainly, I think, peeking at out of the corner of its eye. Like, wow, that now it's the 2 year. Is it going to be the 1 year next? And of course the big one would be if it's the 3 month, 10 year, then that would definitely that was probably a camp we don't want to end up in, and the Fed will probably try to avoid that at all costs. But nonetheless, right now the market's really uncertain how to price in the various moving parts over the next 2 to 10 to maybe even 30 years, given the fact that there's so much uncertainty as to how this is all going to play out.
And hence, ultimately, as you mentioned, again, the extreme swings that we've seen and the overextensions at times, whether it be to the upside or to the downside. We've seen that in both instances multiple times. Dan, appreciate you joining us here. A great breakdown in terms of the numbers, a look at some of the financial markets, and overall discussion in terms of conditions here in the U.S. here with financial conditions here in the U.S. as well. Dan Deming, the Managing Director of KKM Financial, pleasure. And, well, we're going to take a quick break. Stay where you are. When we come back, more futures. I'm going to bring in my chart of the day. We've got a Treasuries trade. We're going to talk options with Alex Coffey, so stick around. We've got our eye on the futures here this morning, and, well, lots more of the information you crave about the markets you trade. We'll be back in just 2 minutes.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
I'm Jenny Horn. Here's a few of this morning's pre-market movers to kick off the trading day. Walgreens posted an adjusted quarterly profit of $1.59 a share, which came in 19 cents above forecasts, with revenue also topping expectations. Comparable pharmacy sales rose 7.3%, which the drugstore chain said was boosted by demand for COVID vaccines and testing sales. Walgreens also maintained its fiscal year guidance, but shares are trading lower following the report. Baidu is following pre-market after the SEC added the company to its list of U.S.-traded Chinese stocks that could face possible delisting. The SEC has laid out delisting for companies they do not allow American regulators to review 3 years' worth of financial audits. As of Wednesday's close, shares have sank over 5.5% month to date. And Amazon has renewed a deal that will allow JPMorgan Chase to issue its flagship rewards credit card, according to reports. The e-commerce company had been in months of negotiations with other issuers, including American Express and Citigroup. The Amazon Prime Rewards card is one of the industry's top co-brand deals due to the large scope of its loyalty program, with an estimated 150 million U.S. members. This has been your TD Ameritrade Network Market Update. Now back to futures with Ben Lichtenstein.
Thank you, Jenny Horn, and welcome back to the Future Show here on the TD Ameritrade Network. It's time for my chart of the day. I wanted to take a look at Bitcoin. It broke out this week, but it's seen kind of limited follow-through. Let's get into the charts, and I'll tell you why I think this is important, why you should be watching it over the next couple days and coming weeks. Here's the hourly time frame. We'll move off the all-time highs we saw back in November, right around the time that NASDAQ topped out, if you remember, and well, we started to sell off coming into the lows into the beginning of the year, and then kind of started to establish a bit of a bottom here in Bitcoin. Now, I want to remind everybody that while March was unable to take out the Feb low, if you remember, the NASDAQ was actually taking out the Feb lows, and well, all four of the majors were able to take out the January lows in the month of February. So again, we did see a series of lower lows in the indices, yet Bitcoin, again, oftentimes associated with that risk on, risk off sentiment. Well, it was kind of signaling that some of those concerns have been a little bit overdone, I guess is the best way of putting it. Bitcoin, again, seeing a series of higher lows after bottoming out in January, February, unable to take out the Jan lows, March, unable to take out the Feb lows, and, well, as mentioned here, straight out of the break, we just recently broke out. Now, I think a big reason why we saw Bitcoin supported was, well, there's been a lot of talk about Russia, for example, accepting Bitcoin as payment for some of the oil that they produce to avoid sanctions and some of the other measures the U.S. and the Western nations have taken to kind of alienate them. Ultimately, this sort of provides that kind of legitimacy argument again. I mean, this is what Bitcoin wasn't originally intended for, right? In many ways, to kind of get away from some of those centralized currencies ultimately and some of the regulatory aspects associated with. Now, take a look here, though, as some of those concerns and, well, talks of Russian troops backing off has seen Bitcoin kind of go a little bit sideways recently. But the point here being, is it a bit of an indicator here in terms of what's to come as far as the indices, potential to follow through? Well, we'll continue to watch these two products together. I just wanted to point out as we move away from this hourly time frame, take a look at the daily. And again, you can see how we're in a bit of a range here now. We've got 30,000 to the downside, 69,000 to the upside. And while, again, this is a very wide range, I think everything in this range is very much noise. So if you're trading Bitcoin, unfortunately, you have to trade a little bit more from a kind of granular look at, because again, there's just not a lot of well-defined trend in terms of the bigger picture time frame. Lastly, I did want to point out the move up that we've seen. Well, much like the indices, we started off the show talking about the ES, the NASDAQ, the Dow, the Russell, where they lie relative to the 50, how all four are above. You can see Bitcoin also holding above that. And, well, again, I think the key here is, do we start to see some momentum to the upside? We oftentimes talk about if we get energy through the middle of a range that we've established, again, in this instance, 30 to 69,000. Energy through 50, 55 here opens up a door for a retest of that upper extreme. We'll continue to watch that as this plays out, that risk on versus risk on sentiment as, well, this market, and it continues to be headline driven. Okay, another focal point for investors and traders is rates on the rise. We were talking about the yield curve inverting before the break, and some of what's been going on in treasuries and bonds. Alex Coffey's joining us this morning, the co-host of Next Gen Investing. He's got his eye on. Alex, good morning to you. A spread that I'd never heard about, actually. I've been around for a while. I'm not by any means a treasuries guys, I'll admit that, but I've heard about the NOB spread, the notes over bonds, but you've got your eye on the TUT spread, the 10s under 2s. Talk to us about why.
Yeah, Ben, I think naturally as we watch this economy progress from COVID's onset to where we are now, naturally the focus was going to be on job recovery. Well, now it looks like we've sort of stabilized the job market. And now the question was, well, was there going to be inflation as a result of policy action, as easy monetary policy and fiscal stimulus, and of course, kind of a roaring economy? Well, the answer seems to be yes. So the next question, I think, Ben, which is natural, is as we try to combat that inflation, and this is the question we're at now, how is that going to impact the economic growth in the picture for the overall economy? And so as we start to look forward, you're going to see new kind of focus on things like growth, things like earnings, more so than we have in the past, where there's been greater focus on price numbers like we got this morning with PCE, and of course on things like the jobs number, which we'll get later on this week. So I think now the focus is going to be more on economic indicators, things that look forward to paint a picture there. And so one of those things, Ben, is the yield curve. And we've seen a lot of headlines over the past few weeks of different parts of this curve inverting. And of course, notably the 10 versus 2 briefly inverted, I believe, a couple days ago. And so this is one that has a pretty strong track record of projecting out when inflations will take place between 12 and 18 months down the road. And so the next question is, well, how can I express some type of an opinion on just that curve? It can be very difficult to project one way or another the direction of interest rates, Ben, but using spreads like the TUT spread, like the knob spread that you mentioned, are ways that investors, traders, retail investors, retail traders can actually express an opinion on the yield curve itself as opposed to just those interest rates. And so 10s under 2s, the TUT spread, it's a way to trade the 10-2 yield curve. CME recognizes this ratio at the moment of 2 2-year treasuries, which is the /Z, T as in Tom, and then that's to 1ZN for the notes for the 10-year. How you actually express this relationship is you take in that ratio opposite sides in both, because we're not projecting, if we sell an interest rate or a treasury future, we're looking for that to be an increase in rates. We're not looking to project the direction of rates, rather, Ben, we're looking to trade the relationship between two different durations. And so the next question is, well, do I want to, express a steepening opinion or a flattening opinion? So far in 2022, the flattener has been the way to go, as it's obviously been a pretty stress-free trade, as that particular part of the yield curve has really compressed tremendously over the last few months. But if I wanted to do a steepening trade, what I would look to do is buy the 2-year treasuries twice and sell one of the 10-year note futures. And then, of course, on the flattening side, we'd be selling 2 years, buying the note. All of this is doing, Ben, of course, remember, price and yields are inverse, is we're just looking to express an opinion on that relationship. Widening, flattening.
Understood. And I think it's key to remember, again, the 2-to-1 ratio. I'm glad you looked into that for us. Now, you and I were talking yesterday about how the CME has products available, the micro yield products that are available, the /10Y, for example, for the 10-year and on into the shorter dated, but they're not as liquid as the futures contracts, right, Alex?
Yeah, unlike what we've seen with some of the micro equity futures. I know you were talking crude oil, and we talked crude oil yesterday. There's a micro crude oil future, there's a micro gold contract that have had pretty nice reception by the trading community since they were actually released, and they're both available, and all available on the Thinkorswim platform for traders using that platform. I believe the 10Y, /10Y, which is the micro 10-year yield future, is available, but so far the liquidity just not there yet for the go-ahead on the other rate products. Ultimately down the line, if they are available, the symbol for the 2-year is /2YY, and you can get the quotes that way, but you're going to see pretty wide markets, not a lot of activity. So for now, the best way and possibly the only way to express this currently as a retail trader is to actually go to the TUT spread.
Okay, so Alex, we're looking at the /10Y here right now. Again, this is the micro 10-year futures contract. So again, a newer contract the CME's made available, a little bit more digestible for many than kind of looking at the ZN contract and the different tick values there versus the bonds and such in terms of the futures. But and a good reminder here in terms of the futures, when you see them trending lower as they have been, you're going to see yields to the upside. Again, that inverse reciprocal correlation. Let's talk a little bit about, Alex, some of the data to keep an eye on if you're trading these spreads or these markets ultimately. You mentioned the numbers here this morning, which we also have some data due out, the wage component tied to the employment number, and as well the non-farm payrolls. I mean, we could see treasuries move significantly in reaction to some of the numbers headed our way tomorrow.
Absolutely, and because we're in this particular spread or the knob spread or anything that's yield curve related, it's more economically tied than just, let's say, inflationary or any type of opinion on things that just affect rates in general. And so while of course we're gonna watch the inflationary data, it's almost more all-inclusive when you're looking at the yield curve, because the actual job growth is going to make an impact. The earnings that come out of mega cap tech is going to take an impact. What the banks have to say, all of this is important because it's all tied to the economic picture in which the yield curve is most trying to project out. I mean, if you think about it logically, in a normal, healthy economy, Ben, we'd expect for me taking more risk with my principal. It's tied up for longer. I'd want a larger rate of return in return for that risk. Well, in an inverted yield curve environment, we're actually getting paid more to put our money away for less time. That's just, it's always been kind of a head-scratching phenomenon for me, and it usually just projects out that there's some uncertainty as for what's going to be going down the line.
Well, we talk about that oftentimes in terms of commodity prices as well, how we see a backwardation occur. And, well, I mean, again, when you're talking about spreads and some of the, expectations for what's to come here, ultimately that's where we get that kind of differential between some opinions, and we're seeing that in terms of markets here play out. Alex, I appreciate you joining us here to take a look at a trade this morning. We're talking again, looking at Treasury futures contracts, a touch spread, and we're talking about the 10s under the 2s in this instance. Alex Coffey, check him out here throughout the day here on the network. And, well, Alex is the co-host of Next Gen Investing here on the TD Ameritrade Network. Thanks for joining us for futures this morning. That's it for us here today. But, well, lots to come here throughout the day. And, well, up next, Oliver Rennick, Morning Trade Live. I'll see you during the day here. And, well, make it a good one this Thursday, this last trading day for the first quarter of the year.
maybe the efficacy of rate hikes.
Yeah, entirely possible, Oliver. How I see it right now is absent major surprises in both job growth and job-related information alongside inflation and inflation-related information working in both directions. I don't think that the market's going to react that strongly to it. I've been surprised before, but I think that those two situations are, for the most part, pretty understood by the market right now, and there's particular risks that are being priced in. That leaves one other factor, and that is, what is the economy going to be able to stomach in terms of action being taken by the Fed? Obviously, if you have some type of disappointment in the jobs data on a consistent basis, reason to believe the economy is slowing, maybe the Fed changes course and that changes the picture. But right now, you see the Fed about as hawkish as we've seen them in the last 5-6 years, and the market pricing in that they believe the Fed. All the while, we're starting to see signs that things could be slowing down a little bit. Oliver, and then you talked about Apple at the top of the show, and I think that highlights another really key issue. You really have 5, 6, 7 tech stocks that have been very, very strong, continue to be strong, really hiding a lot of weakness under the surface. I know a lot of these names have bounced back a ton from their lows, but they're still 40, 50, 60, 80% in some cases off of all-time highs.
Sure. Okay, not the giant techs, but some of the other important names for sure. In fact, we got a great chart coming up that shows how the mega caps have bounced back, because it is certainly not unanimous. To your point here, it's not uniform, the degree to which they've come back. Apple certainly stands out. All right, nice commentary. Thanks, Alex, for the look at the data. Let's bring it, Ben, fresh off the futures show. Crude's down this morning. Ben, we got a lot of crude news. That OPEC meeting seemed to go pretty much as planned, the way the market had expected, but then a little bit of a surprise, possibly, a Bloomberg report and a few other stories around the administration potentially releasing oil reserves to the tune of 1 million barrels a day. That's a lot, right?
That is a lot, Oliver, and there's a few factors to consider here. If you're trading crude oil this morning, you can see some of the volatility we've seen in the overnight session, and it really speaks to what a headline-driven market this has been, whether you're talking indices or crude. And again, a perfect example.
Every day, this thing does not stop moving.
It doesn't. Currently down around 4.5%, but we traded as low as $100 a barrel. Now, keep in mind, when we're talking about crude at $100 a barrel, it still feeds into those inflation concerns that Alex was just talking about and some of the conditions the Fed was having to deal with. Oliver mentioned OPEC along the lines of what we were expecting, a small increase over just over 400,000 barrels. But ultimately, the real story this morning, as Oliver mentioned, was the White House expected to announce the largest release in the near 50-year history of the SPRs. So we're talking about 1 million barrels per day, as you mentioned. This will go on for 6 months, so 180 million barrels. Now, I think, again, what's really important to remember is this is going to be the third, if it happens, it'd be the third.
Not for sure yet.
That's right. It'd be the third in the last 6 months. Now, keep in mind, again, if we look at a bigger picture chart of crude oil over the last 6 months, we've seen this.
All this fits in to the large trend.
But the point here, it hasn't really helped ease price pressures much. I mean, we came off the 130 high. That was more Ukraine, Russia related, more so than I think release of strategic petroleum reserves, or even we've heard about some of these gas tax reliefs of states, and some of the governments here in the U.S. are helping relieve some of the pressures at the pump. But this one's also interesting because it's being talked about as on a concerted effort from the IEA as well. They're gathering officials from Australia, New Zealand, Japan. We're expected to hear something possibly from them as soon as tomorrow. They're calling for this emergency meeting again tomorrow. But as to my point here, we've been releasing strategic petroleum reserves and trying to ease some of these pressures here, Oliver, and it hasn't really helped. Still holding elevated at 103. Now,
103 doesn't look particularly low on this chart.
Not at all. And this doesn't even go back to the pandemic lows, which keep in mind we're down at $6 for the continuous contract. So, you know, our guest this morning on the Futures Show, we had Wayne Kaufman join us from Phoenix Financial Services, and he spoke to this point. He said that it was really an example of, and the headline-driven volatility we've seen and the ups and downs in the intraday is really an example, as he put it, everything is going on and really highlights the terrible governmental policies we've seen as we hop from crisis to crisis, and we don't really have a plan to deal with any of this. So on a daily basis, we're kind of coming up with these Band-Aid fixes, and ultimately look where crude prices are as a result.
The biggest example being we exit COVID risk and enter straight into inflation risk, and then also the geopolitical one. It's tough to dodge some of these punches, but it's when you can't see them coming, right? So at this point, we know our issues, and crude is not really changing its path at this point, even with a 5% drop, barely registers on the chart. Okay, appreciate it, Ben. Thanks for the update, the data here. A lot of information for the crude oil traders. We'll see if it can hold $100. When we come back, Liz Ann Saunders, don't miss it before we open up the bell here. Got about 15 minutes until the bell rings. Right now, futures are mixed. NASDAQ a little bit higher, but red generally across the board here.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then create watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watchlist, then select save. The existing list is replaced by the new one. You can also create watchlists from the Market Watch tab. After creating a watchlist, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watchlist. From the Scan tab, right-click a security and then add to watchlist. And that's how you make a watchlist. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
The NASDAQ rallied 17% off this month's lows before finally stalling out just a tad yesterday. Let's check in on the status of the rally with Liz Ann Saunders, Chief Investment Strategist at Schwab Center for Financial Research. Liz Ann, good morning. Good to have you back.
Good morning. Nice to see you, Oliver.
You describe this rally in your notes as not in sync, the market not quite in sync despite the strength we've gotten. Tell me what that means.
Well, some of the breadth measures have improved significantly, but you also still have a decent number of new lows being made in addition to new highs. And a lot of where the rally has resided is in areas that had been hit most during the downturn. And there are some indication that a lot of that is short covering. There's been a lower quality bias to this recent rally, which might be suggestive of a better economic outlook, but I think is tricky to bet on that as a continuing play, more of a short-term kind of oversold move. I still think quality, focus on quality makes sense in what I expect to continue to be a choppy environment.
It seems like even within tech, there's been some choosiness. The chart of Apple looks really, really impressive. kind of looks like the market's ready to go back to that big tech growth theme. But then you got Meta way behind, and a list of other cloud companies when you go down the market cap range that are still deeply off those highs, to your point. So are we seeing the market get a little bit specific and keep some of that stock picking mentality even when things have rallied back?
I think so, Oliver. And I think you and I probably talked about this on your program in the past. I think there is more discernment now on the part of investors broadly, stock pickers specifically. And I think what we've exited is the pandemic era of being able to look at whether it's the big five, the super seven, the FANG plus, however you want to categorize. You could look at them with a monolithic lens. They behaved as the pandemic defensive areas. But as we've seen their fundamentals diverge, we've also seen sort of a more discerning palette on the part of investors and even traders. And that's why you're seeing it's just sort of a wider breadth of performance among even those names that historically acted in a monolithic way. And I think that's the way investors and even traders should approach the market is make sure you're investing based on those fundamentals and don't have narratives drive themes around big groups of stocks en masse.
The ranking of some of the giants I'm looking at from a really cool chart showing those drawdowns on your Twitter. Apple looking really good. Right behind it, Google the closest to its highs. Microsoft's in third place. And then you drop to Tesla, NVIDIA, and then, of course, Facebook still down about 40% off the highs. So folks should go check that chart out. Let's talk some macro and some economics this morning, Lizanne, with the PCE number out here, basically in line with expectations. A first step possibly to some peace on the inflation concern, or is this still have more surprise left possibly?
Well, I guess it depends on whether you're talking about the core measures of inflation or headline. And I think headline will continue to be driven by the war between Russia and Ukraine and the volatility that we're seeing in food and energy prices, and assuming no somewhat peaceful resolution, which doesn't seem imminently to be in the cards, I think that pressure on headline inflation is likely to persist. But we are starting to see some signs of pent-down demand on the goods side of the economy. And of course, it's the goods component of core inflation measures that really skyrocketed starting last year. Plus, we've got the base effects on the core in aggregate starting to kick in. So we may, I don't expect a big decline that's about to start, but the rate of change might start to settle into a little bit better a path on core measures. You know, outside the inflation data, you had decent revisions, including for things like personal spending. The problem with a lot of these consumer-oriented metrics, whether it's consumption or spending or personal income, the nominal numbers still look decent, but the problem is you're subtracting a pretty lofty inflation rate. So the real numbers are in negative territory. And I think that's been the particular rub in these data points, and part of the reason why the expectations component of metrics like consumer confidence or consumer sentiment has sunk so significantly because of that weight of inflation on not just spending, but the psyche of consumers.
Yeah, it's going to maybe be a slightly slower turning ship than just the actual prints that we look at month to month here as we wait for people to really see that price change happen. Don't think it's coming down from what I see just yet around me, and the data here is still 6.5%, very high. Lizanne, you looked at the CPI, a different inflation figure, but still an important one relative to economic activity. It's a pretty interesting chart that you put up that we're going to pull up here that shows an old way things were done versus a new one, and I'm curious how that works now. If we've had kind of a relationship change where up until 2000. You had counter-cyclical inflation that went inversely with economic activity. Not that one. We're going to pull up another chart. Lizanne, how does that work? What type of response?
Counter-cyclical inflation, which in general defined the era between the 60s and the 1990s, where you also, by the way, that was also the era where bond yields and stock prices were inversely correlated. And that was more of, as we all know, an inflationary backdrop the economy, both in the US and globally, was more susceptible to supply shocks than demand shocks. And when we would have these spikes in inflation, it would contribute to downward pressure on demand and growth. And then really the very late 1990s, call it 2000 for rounding purposes, up until the pre-pandemic period of time, we were in a disinflationary backdrop. Bond yields and stock prices were positively correlated, and it was more pro-cyclical inflation. So stronger demand would tend to put upward pressure, albeit for a short period of time, on inflation. Now I think we've reverted back to this counter-cyclical inflation, where last year's pro-cyclical turned into counter-cyclical, in that inflation got so high that those high prices started to put downward pressure on demand and growth. Whether this is now the beginning of another secular period like the 60s, 70s, 80s, I think it's too soon to tell, but I think that relationship between bond yields and stock prices may hold the key to indeed whether that's the setup for a secular period like that.
Super important analysis that shows us there are times when inflation is good and times when inflation is bad, and it seems like very specifically and explicitly right now, it's one of those inflation is bad moments. Lizanne, we've got that other chart actually that's super interesting as well, which is the consumer